Have you ever noticed how the market often feels calm right before a storm? The truth is, financial markets have their own way of warning us, but the signals aren't always loud. One of the quietest yet most reliable signals is something called a credit spread. And right now, this silent alarm is ringing louder than ever. In this video, we're going to unpack this mystery in simple language. You'll learn what credit spreads really are, why they matter for both Wall Street and Main Street, how they cycle through different phases, and how smart investors hedge their risks. We'll also talk about the psychology driving today's tight spreads, the real risks that lie beneath the surface, and why history tells us to pay attention. By the end, you'll understand why credit spreads are like the market's early warning radar. Before we dive in, make sure to hit the like button and subscribe to this channel. I share insights on finance and markets in a way that's simple, clear, and connected to your everyday world. So, if you want to stay ahead of the curve, click subscribe now. Let's start with the basics. Imagine you're at a fruit market. One stall has perfect, shiny apples. The other stall has apples that look a little bruised. Which one would you buy? You'd probably pay full price for the fresh ones, but for the bruised ones, you'd expect a discount. In finance, that discount is like a credit spread. It's the extra return you get for taking more risk. For example, if a 5-year company bond pays 6%, while a 5-year government bond pays 3%, the spread is 3%. When investors feel safe, they're okay with a small spread, just like being fine with paying almost the same price for slightly bruised apples. But when investors get nervous, they demand a bigger spread, just like wanting a big discount for riskier fruit. Here's the worrying part. Right now, those spreads are extremely small. By the middle of 2025, safe company bonds are paying only about 0.8% more than treasuries. That's the lowest level since before the 2008 financial crisis. Even junk bonds, which are supposed to be risky, are paying just 2 to 3% more. That's historically very low. Cheap borrowing sounds like good news for companies. They can refinance easily, issue new debt, and fund growth. But history shows that when spreads get this tight, it often means investors are too relaxed right before a shock. That's exactly what happened before the 2008 crisis, and again before the 2020 COVID market crash. The numbers suggest we could be in the same place again. Let's look at an actual chart. It shows US high-yield credit spreads, which measure the extra return investors want for holding junk bonds instead of government bonds. In early 2020, during the COVID panic, spreads shot up to nearly 10%. Investors were scared and demanded a big reward to take risk. That shaded area marks the recession. But after the crisis, look at the line. Spreads dropped back down steadily, and by 2024, they were just above 3%. Compare the towering spike during crisis to today's tight levels. Low spreads mean optimism, but they also mean complacency. When spreads are this tight, investors may be ignoring the risk of future trouble. To understand this better, we need to see the bigger picture. Credit markets move in cycles, just like the economy. There are 4 phases: expansion, late cycle, downturn, and recovery. During expansion, the economy is strong. Companies can borrow cheaply, investors are eager to lend, and defaults are rare. Spreads narrow as everything looks safe. Then comes the late cycle. The economy is still okay, but there are warning signs. Companies already carry a lot of debt. Lenders loosen standards. Profits stop growing as fast, inflation pressures build, and cautious investors start shifting money from junk bonds to safer investment-grade bonds. After that comes the downturn. Borrowing costs rise, spreads widen sharply, defaults increase, and lenders tighten their rules. Companies cut investment and slow hiring. Finally, we get to recovery. Fear fades, spreads narrow again, and companies can borrow at lower rates. Confidence slowly returns. Where are we today? Many signs suggest we're in the late cycle stage. Companies borrowed heavily when interest rates were low, so debt levels are high. Earnings are still good, but growth is slowing, and that often leads to falling profits. Investors are already moving to safer bonds and shorter maturities. After years of easy credit, things are looking stretched, and history says the next phase could be a slowdown. Credit markets also have a habit of warning us before the stock market does. Here's another chart that shows the global financial crisis in blue and the COVID crisis in orange. During the Great Financial Crisis, spreads crept up in 2007 and then spiked to over 300 basis points. This happened months before the stock market fully collapsed. In the COVID crisis, spreads jumped by 250 basis points in just weeks. Stocks crashed almost at the same time. Why does credit often lead equities? Because bond investors are focused on whether companies can repay their debts. If refinancing gets harder, they demand higher yields immediately. Stock investors, on the other hand, often ignore the warnings until it's too late. Today, spreads are at just 79 basis points above treasuries, the narrowest since July 2007. That was right before the GFC. When spreads are this tight, history suggests markets may be underestimating risk. If spreads start to rise, stocks could soon follow. Now, let's talk about high-yield bonds, also known as junk bonds. They pay higher interest, usually between 6 and 10%, because they're riskier. That extra return is tempting, but it comes with higher volatility and a greater chance of default. Some investors try to make money when junk bonds fall in price or spreads widen. They do this by shorting. They might short sell bonds directly, use credit default swaps, enter total return swaps, or use inverse ETFs like SJB. But here's the catch. Timing is everything. Short too early and you'll bleed money paying fees and coupons while nothing happens. In fact, in 2024, many who bet against high yield lost money because spreads stayed tight and prices even went up. Other investors prefer hedging instead of outright shorting. Think of it like wearing a seatbelt. You don't slam the brakes, but you protect yourself if there's a crash. They buy credit default swaps, interest rate swaps, or options on bond ETFs. These hedges are cheapest when markets are calm, like buying insurance when the sun is shining. But once panic hits, the cost of hedging skyrockets, and sometimes it's too late. That's why smart investors say the best time to hedge is when it feels like you don't need to. So why are spreads so low right now? A big reason is psychology. After years of strong returns, investors fall into what's called recency bias. They believe the good times will just keep going. With defaults at record lows, everyone is chasing yield. Safe bonds don't pay much, so investors crowd into riskier ones. It's like a packed party. The more people that pile in, the hotter it gets, and more people want to join. That feedback loop drives spreads even lower. It feels euphoric, almost like a bubble, and just like in 2000, 2008, and 2020, that mood can reverse sharply. Remember, credit spreads don't just affect Wall Street, they spill over into the real economy. When spreads are low, companies borrow cheaply, fund projects, expand, and hire more people. When spreads widen, borrowing costs rise, companies cut back, freeze hiring, or even default. That's how credit stress often triggers recessions. And there's another hidden risk: liquidity. Since 2008, banks have kept smaller inventories of corporate bonds because of stricter regulations. That means fewer dealers are ready to absorb big sales. At the same time, bond ETFs have exploded in popularity. The danger is, if investors rush to sell, those ETFs still depend on the underlying bond market, which is less liquid. This mismatch can cause sharp price moves. In March 2020, it got so bad that the Federal Reserve had to step in as the buyer of last resort to stop a total freeze. So, what's the takeaway? Today's near record low spreads reflect real economic strength, but also a dangerous level of confidence. When everyone thinks nothing can go wrong, risk is often building under the surface. History shows that credit spreads almost always flash warning signs before stocks collapse. Right now, the bond market is whispering a warning. The question is, are we listening? If you found this video helpful, don't forget to hit like and subscribe. It really helps the channel grow and ensures you don't miss future insights. The markets may be whispering, but together, we'll make sure you hear them loud and clear.